Now, it's no secret that online trading can be performed more efficiently if you possess the necessary tools. And education and experience combined with exceptional risk management are the only keys that will make you a successful trader. So a good place to start is learning the basics for and understanding price charts, whether you're going to trade from technical analysis or whether you're going to be a fundamental trader. No matter how you're going to trade, you need to be able to look at a price chart and understand what it's at least trying to tell you. Not necessarily use it for your trading decisions. Do whatever you want to do, however you want to do it. But you have to be able to look at a chart and understand what it's saying. Because if I were to say to you, the euro is trading at 132 now, and it was 131.97 when it opened, and went 132.94 before it closed, and then it jumped up to 133.94 and went back down to 192. Can you tell me what happened with the euro? No, because mentally, our brain can't comprehend this. But it's like that old saying, a picture's worth 1,000 words. When we put these prices on a chart, your mind can then understand and see what is happening, and you can see patterns. So whether you're going to use fundamental, technical, or quantitative analysis, there are a number of methods used by traders to predict movements of currency pairs. Some traders focus on news, interest rates, economic variables, while others prefer to use charting tools and indicators. That's your choice, but you still have to have a basics. Now, however, no matter your trading method, you'll need to know how to read a chart. There's no escaping it. Luckily, we've created this webinar to help you understand. And remember, you must crawl before you can walk. And charting is no different. You need to have a good understanding of the basics before you can progress to the advanced stuff. So a chart is simply a graphic depiction of the current and historic price of an asset. It's its journey. It's its roadmap. But nothing on it can change. It is finite. It is defined. Okay. The price on your chart is no different than the price on the guy across the world's chart and everybody's chart. If you want to know what the euro was at the close of 1 hour at 1 o'clock today, the euro price, no matter who you talk to, was the same price. It is a finite, defined number. It doesn't change. It's not adjusted. It is a known quantity. Now, I will tell you a wee little bit to give you some insight about charts. Okay. Now, charts are based on data feeds because all of this data has to be fed into your charts to put it in a visual representation. And these data feeds, remember, you've got to have a data feed for every single asset. That's a lot of data feeds. And you have to store all of that historic data. Because when you're looking at a chart and you jump over and you're looking at a 15-minute chart, you're looking at everything that happened 15 minutes all the way back a couple hours. But if I flip you over to a one-day chart, you want to see what the one-day chart looks all the way back. That's covering a year's worth of trading. It's got to be there. It's not like somebody's got to call it up from somewhere and put it together in a chart and you're waiting 5 minutes for it. No. So all of this is in data feeds. And they're very, 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 very expensive because you buy and pay for the data feeds. Now, when you look at charts that are provided free of charge, like an investing.com or FX Factory or Forex Street, okay, they are delayed charts. Not that their prices are any different, but when you pay for a feed and you don't pay for the instant feed and you pay for it, 10-second delay, the price goes way down. Okay. Because then they're not feeding it out in the first bunch. When you have a 30-second, that doesn't mean that the 1 o'clock price is any different. It means you'll get the 1 o'clock price on those free charts at 10015 or 10005. It's a slower feed. Now, nobody is trying to pull the wool over your eyes. Nobody in the market are deceiving you. When you go to TradingView and sign up for the free charts, it tells you when you sign up that you're getting a slightly delayed feed, because they're not going to give you the same feeds that they're paying huge amounts of money for. They're going to give you a little bit slower feed. When you're in your investing.com, if you look in the fine print, it tells you that their feeds are, but you're not paying for it. You're just looking at it, and those charts shouldn't be used for making your trading decisions. Now, when you're with ETX, you get the ETX charts on the platform. Okay? You should always use the charts provided you by the platform, because the platform is getting the fastest data feeds possible. Not just because for the charts to give you charts, it's because they've got to have the up to the second prices to be able to be quoting you all the prices of all those assets so you can be trading. And those are the same data feeds that feed in all those prices that go to the charts. So you're getting the fastest feeds possible. Or if you're paying for an expensive charting service, okay, if you're getting in TradingView and paying for one of their Pro series, you're going to get fast up to the second chart. You're going to get the fastest feed possible. So keep that in mind. Okay. Now, to be honest with you, most traders don't need a feed that's that exactly fast. Okay. Because you're not making your decisions in split seconds. But keep this in mind. But you should always be using then the charts on ETX. They're free to you. Now, charts come in many different modes, display modes. There are three broadest categories of them, and three of the most popular that we know about. We have the line chart, the bar chart, and the candlestick chart. Now, candlesticks have become the buzzword for online traders. And we're going to go over candlestick charts tonight. My fact of the matter is I use bar charts. And I flip today between candlesticks and bars because they're easy to flip back and forth from. When I first started trading 45 years ago, we didn't have computerized charts. So we were sitting there with graph paper charting the assets that we watched and putting all the little lines on our charts. It's a lot easier to draw a bar chart. So very few people use candlestick charts. They were time consuming when you're drawing them by hand. Today, because of HTML charts and Java charts, you get all the data and get all the charts so fast and instantly you don't have to worry about it. But the basics are a line chart. And what you're looking at on your screen is a line chart. Now, we're going to be comparing three different types of charts. But in tonight's class, we're using the same asset, the Euro US dollar 30-minute chart, for the same time period, the same everything. So you can see the difference from one chart to the next. Okay. So this is the most simple of charts. It's called a line chart. We use the close price of each, in this case, 30 minutes, to put a dot on the chart, and we connect those dots with a line, and it gives us the line chart. Now, there's very little we can perceive from a line chart because it's not giving us anything but the close. Now, again, we'll go into one of my little side trips. Actually, let me take you over to live chart. Okay. Now, we're looking at a live chart for the Euro US dollar 30-minute chart, which is my standard teaching chart. Same charts you were looking just in my PowerPoint, but these are current up to the second charts. So we're looking at a line chart. Now, because we have all this computer development out there, and all these developers who don't know trading, and then we have all these people involved in the IT departments and from all these brokers and everything, to me, they're giving us way too many choices. Because you can see, if I click on my settings button, okay, now why aren't my settings opening up? Okay, let's try this again. Hold on a second. I'm going to reboot this because for some reason it's not giving me. There we go. Now, we are looking at the settings for the charts. Now, because all of these developers have done all this crazy stuff out there, we can actually set up our bar chart, or I mean our line chart, using the open, the high, the low, or the close. The standard has been for my 45 years of trading has always been a line chart was based on the close, but you can adjust it. Now they also will give you the high and the low divided by 2, the high, the low, and the close divided by 3, the open, the high, the low, and close divided by 4. Well, that's a bunch of wasted time, effort, and space, but I can no longer say it's only the close. But this is what everybody uses for a line chart. It's just simply the close because we're not using a line chart for making trading decisions. We're looking for a line chart to just see what the price an asset is doing at the moment because we're not getting enough information. From a line chart, we go to my favorite chart, and that's a bar chart. Okay, a bar chart looks a lot different than that line chart. It's the same prices, same time frame, same everything, except the bar chart tracks the open, the high, the low, and the close. Now, it's sometimes referred to as an OHLC, open, high, low, and close. And each one of these bars on a bar chart covers that half-hour period. In this case, a 30-minute chart. If we were looking at a 1-hour chart, each one of those bars would cover a 1-hour trading period. Prices don't change, just the trading period. So imagine if I said the euro was trading at 110.11 at the beginning of the hour, and at the end of the hour it was trading at 110.54, okay, we would have a line or bar that went from 110.11 to 110.54. That would tell us everything it did in that 1 hour. Now, if we change it to a half-hour chart, those two bars, one would open it's still at that 111, and the close at the close of that hour would be the second bar at 1054. But we would see a breakdown because what happens in that 1 hour, price pushed all the way up to that 110.54, and in the next half hour fell all the way down, and that's where we got well, when we break it down, we see divisions or finite details of what happened in that period. So here it would take two bars to encompass the 1 hour. Okay, well, this is a 1 hour. Okay, so this 1 hour's worth of trading right here would actually encompass 2 of the half hours, which would be this bar and this bar. Well, you see a lot more things happen in that 1/2 hour, in those 2 single half hours than we saw in that 1 hour. So there are many reasons we want to look at smaller term charts, but we also have to adjust the time frames to fit our type of trading, because you could drive it all the way down to a 5-minute trading. Then you're really not getting any feel for that asset. You're getting such little things that happen. So most of us that are trading in short-term trades like CFDs, we're looking at a combination of 1-hour charts, 30-minute charts, and 15-minute charts. 1-hour chart gives you is what you would look at to decide whether I'm going to consider a long trade or a short trade, or am I going to trade at all? A half-hour chart is where you would do your analysis and you'd use your 15-minute chart to find the actual entry point in which you'd want to enter the trade. So each chart would serve a different, each time frame would serve a different period. But before we go back to that, let's go on and talk about the bar chart. Okay, so each one of these bars represents, in this case, a 1/2 hour period. So at the beginning of that half hour, we put a dash to the left. At the close of that half hour, we put a dash to the right. We then put a dot at the highest point it achieved in that 30 minutes and a dot at the lowest point it achieved in that 30 minutes. And we draw the bar together. And this gives us our open, the high, the low, and the close. Now, if we stepped up the ladder from the open to the close, we would have a bearish session. If we step down the ladder from the open to the close, we would have had a we would have had a bullish session if we stepped up and a bearish session if we stepped down. But we can also start to see in a bar chart prices. Like here, we can see a defined trend line, but we can also see prices that are very, very important as prices move down. We can see prices that have some commonality across the line. We can actually see, look at this downtrend. We can see the tops or the highs all staying within that realm. Here in this slight uptrend, we can actually draw a line underneath. We start to see visually common things or what price is trying to tell us. It's starting to tell us what price action is. Okay, so this is one of the reasons we want to use the visual representation. Now, remember, there's only 4 pieces of data: open, high, low, and close. So if we want to use a candlestick chart, we can just click on candlesticks. Now, candlesticks have the same exact information: the open, the high, the low, and the close. Except it looks a little bit different, but is exactly the same. Now, one of the fallacies that new traders have with candlesticks is that they assume that the reds and the greens are telling them something. And they start to think when they see lots of red that they should be selling, and when they see lots of green that they should be buying. Well, that's far from the truth. So let's first talk about the formation of a candlestick. So to form this candlestick, instead of putting a dash across at the open to the close, we actually put a line at the open and we put a line across at the close. We still put a dot at the highest point it achieved, and we put a dot at the lowest point it achieved. We connect those dots to the lines and then connect the lines to the lines. And this forms what we call the body of the candle. These are known as the wicks or the shadows of the candle. Now, if we closed higher than we opened, so we stepped up, we would fill this candle in with green because it would have been a bullish session. If we step down from the open to the close, we would fill this candle in today with red. But let me just get all my markings up here. This really doesn't matter anymore. You could have a gold and a purple. As long as you knew which color you're using for bullish and which color you're using for bearish, it's perfectly fine. Now, in the old days, And the reason I'm going to tell you this is important is, okay, let me get. I'm just taking you back to the old days. Hold on a second. And it's important you understand this. Oops. Not easier. Too many choices. Okay. In the old days, when we were hand charting, we would fill in the bearish time frame with the side of our pencil that we were using, and we'd fill it in with black. And if it was a bullish session, we would leave it with empty. Or so it, on the background, it looks like it's white. The reason I'm telling you this, and it's kind of important to remember, not that you have to memorize it, but you have to be able to recall it, because when you start to learn about candlesticks, a lot of candlestick patterns have names, and these names came from way back when candlesticks were created. Okay, and there are things like 3 black crows, 3 white soldiers. Okay. Today, you might call them 3 green crows or 3 red soldiers. Okay. And an evening star and a morning star, because in the black and white system, this is what they had. Today, in our colored system, you would get lost if I told you you had 3 black crows. Okay. So you have to understand where these come from. Lots of literature and information you read will be talking about black and white candles. But again, one's bullish, one's bearish. Okay. So now we can go try to create them back to where they were. And again, like I said, today they give us away just too many choices, too many buttons we got to click on. So I'm going to leave it. So now we have the red and green candles. Now, I mentioned one of the biggest misnomers about candlesticks is the red and green. Now, we are human beings, and we trade in the markets are based on human psychology. And because we see these reds and greens, and we see these abundance of reds and greens, we tend to make decisions, especially when we don't know how to use candlesticks. And this is where a slight problem comes in, because candlesticks are more about the body of the candle, the shape of the candle, the size of the candle, and then its relationship to the preceding candle. Now, there's lots of what we call candlestick pattern recognition. And like I said, there's 3 white soldiers, 3 green crows, evening stars, morning stars, all of that's candlestick pattern recognition. But let's not even get into that tonight. We have a whole class. In fact, we have a 2-week class on just pattern recognition. But pattern recognition is really a waste of time. Okay, it's memorizing specific patterns that appear and exact definitions that go with them. And the fact is, doesn't work so well. But understanding the relationship from one candle to the next and what those candlesticks are telling you, understanding what the shape and the size of the body is telling you, is very, very important. And then incorporating them in. There are certain patterns like bullish engulfing and bearish engulfing that are very, very reliable. And this tells you when a trend, or predicts to you that a trend is over. Now, we use common sense. If we see a big downtrend, and a downtrend would be making lower lows and lower highs, and it should have, red candles marching down the thing. intermixed with green, but then we see a red candle, but then we see a big green candle next to the red candle, fully engulfing the previous candle. So that means the bulls came to life and dominated that market. And it's got a pretty specific definition. Okay. And that bullish candle needs to engulf everything of that prior candle so that the bulls completely took out the prior move. And that's telling you that trend is ending. Not necessarily at that precise second. Now, when we get these, okay, we can at least decide what's happening in the market. When we see tiny little candles with virtually no body, that's telling us we have a lot of market indecision. So these are things about candles, and these are things you should know if you're going to use them. But just looking at the candlestick chart, okay, and seeing trends and support and resistance and swing highs and swing lows, a lot of people prefer the candlestick. I think my eye gets very cluttered when I see all of this, and I would rather see this way. But that's completely up to your own personal preference. My preference is because 45 years ago, this is what I was drawing on the charts. I'm used to seeing those. And your charts need to be adjusted to what you're comfortable with. Okay. Now, things like the width of a chart, the height of the chart are all personal things. Like I like narrow little lines. I don't like, okay, all the same thing. Nothing's changed. It's just its appearance on the charts. Same thing. We go to candlesticks. I much prefer narrow candles. So my charts are always set to the same. But this is up to you personally. Doesn't change the price. Doesn't change the candlestick. Doesn't change the bar. All it changes is your view, the field of view. Because as we change this, because see along the bottom here, we see the time periods we're looking at. Okay, you're not changing anything with the prices. You're just changing how much you're actually seeing across the visual representation of the charts. Some people want to see more large, they prefer this. Doesn't make a difference. It's completely up to your own preference. Now, one of the main reasons we learn to use charts is so that we can apply technical analysis. Now, technical analysis is a big, scary word. So I use the word chart analysis or price analysis because basically technical analysis is anything and everything you do on a chart. So if you're going to look at a price chart, or you're going to come on here and you're going to put support and resistance lines across your chart, you're going to analyze a price dip. It's all technical analysis. If a lot of people mix it up with putting things on your chart that we call technical indicators. And one of the main reasons we do learn to use charts is so that we can apply these technical indicators, or so we can see price patterns, or that we can put trend lines on our charts. All of this is very, very important. But again, this becomes all the way up to you. Okay. But being able to see price movement or price action on a chart and understand what price is telling you is always going to be very important, because no matter how you're going to trade, whether you're going to wait for a Google quarterly earnings report come out and you're going to go page by page, item by item, and master it all going along the way, that might tell you Google's going to go up. But you see, it doesn't help you decide what price you're going to buy Google for, where you want to get out of the markets, where it's going to, you're going to realize, oh, the price is already soared up, so it's too late for me to get in. Or if the market's turned against you, you're only going to see that on a price chart. Or your buddies can tell you buy Google at 147.2 and sell it at 157.4. Okay. Well, if you want to listen to what he's telling you, that's fine also. You don't have to memorize prices. Now, with ETX, you have a whole list of technical indicators that you can add to your chart. So I want to show you, I got a presentation prepared for you, and I want to show you how you would use the charts on the ETX platform and how to put technical analysis on there. And then I'm going to show you also how to do on-chart trading, because on ETX you can trade and open and close your trades and adjust your stop losses and everything else directly on price charts. So you don't have to watch price as much as you can, look at these numbers as much as you can look at your charts, and then just pull up, where you want your, if you want to move your stop loss up, move it down, you want to enter a trade, just click it right off on the charts. But here, let me share with you first how you put all the different technical indicators on the charts from ETX. So now that you've seen how you would add and adjust the charts on the ETX platform, I want to show you how you would actually trade directly from them so that you have a good understanding of charts